very good morning or good afternoon to you all, wherever you're joining us. This is the fifth workshop in our series of climate finance, climate and energy transition finance. We started the process late September with the very first workshop focusing on the different types of risks that are prevailing or emerging in the climate finance arena, particularly focusing on energy transition, green hydrogen, and other energy forms. And we were able to highlight and identify more than 45 individual risk classes, which is quite important because if you are able to identify, quantify, and price risk, you're able to finance risk as well. The next workshop, the second one, was on how do we stimulate demand for green hydrogen, given the uncertainties on a number of fronts. And a number of measures were identified by our panel of experts on stimulating demand. The subsequent workshops were focusing on two very important aspects. One, the value chain of green hydrogen, which is of which renewable energy is a significant contributor. And we identified that whilst there's tremendous capacity within the system, but the system is going to get deluged as India establishes a very high target of adding 50 to 75 gigawatts capacity every year from now till 2030. And that would need almost $300 billion of capital just in the renewable energy sector. And a significant risk on financing was identified as a key barrier. The previous workshop, the fourth in the series, focused on how do we create structures to make markets. A lot of us who are in the green hydrogen sector, keep on talking about, hey, who's buying, right? And if people are buying, then they are not giving long-term offtake. So it was a very, very interesting discussion we had on how do we create a structured framework through which markets could just not only be aggregated, but also risks assumed. And in doing so, we recommend a very interesting market-making framework, the summary of which is available in the workshop. So I encourage those of you who have not seen the proceedings or heard the discussion, please go to the workshop folder and you should be able to do the same. Today's workshop is focused on assuming the market-making structures are available, assuming there is capital available, but how do we bring the confidence in the counterparties? And we're delighted to have Jae Hyun Kwon, who's the head of South Asia for World Bank's MEGA program, and Bhavit Sharma, who's the Senior Investment Officer for AIIB. Gentlemen, welcome to both of you, and thank you so much for taking out the time today. We'll keep the dialogue very free-flowing, and as always, whoever has questions and comments, feel free to jump in. Today's workshop, we're trying to keep it down to a maximum of 90 minutes, but we'll see how it goes. Most workshops were 2 hours long, but given this is a very technical subject, we think we can cover the dialogue and discussions within 90 minutes. So with that background, I'd like to sort of kickstart the discussions. First questions to both Jay and Bhavit, if you could just briefly highlight the role your respective institutions are playing and the kind of guaranteed products that are on the offer from your institution, but also from others in the field that would help our participants get a better understanding of why those guarantee instruments are needed. So Jay first, and then Bhavit.
Thank you, Samit, and Thank you for inviting me. It's a great pleasure to be involved in this very important discussion. So my name is Jae Hyung Kwan. I am MIGA's head of South Asia, based out of Delhi, India, looking after business origination in South Asia region. MIGA is the World Bank's kind of guarantee / insurance arm. We provide guarantees in two main buckets. One is the credit enhancement, which is basically a very comprehensive cover for lenders, mostly commercial lenders, for public projects. The second is a political risk insurance, which provides risk mitigants against specific risks, namely involving the transfer restriction and currency inconvertibility, expropriation, war and civil disturbance, and breach of contract. In India, we are focusing on, first of all, the credit enhancement, especially at the SOE or PSU, as we call them in India, the public sector undertakings that require external commercial borrowing. And we can provide a credit wrap on that, which leads to longer tenors and lower pricing. And on the political risk insurance, India is very politically stable, so most investors don't need covers for expropriation, war, civil disturbance, obviously. But the breach of contract is a cover that would be useful and that we have been asked to provide in the Indian context. And this breach of contract is basically a compensation that MIGA provides in case of a breach by a government entity on the contractual obligations under a PPP type arrangement.
Thank you, Jay. Bhavit, would you like to go next?
Yeah, sure, Sanmit. Thanks. And thanks, Jay, for the introduction. So myself, Bhavit Sharma, I'm part of AIIB's financial institutions and syndications team, which is primarily responsible for FI origination, as well as looking at our guarantee products. So I've been, supporting the organization in the development of the guarantees product, as well as supporting some of, almost all of the guarantees projects, which are currently on and have been recently concluded. As most of you know, AIB is one of the youngest, the youngest MDBs, came into existence back in 2016, and have recently operationalized its guarantee program to support our member countries, primarily for infrastructure development. And the key reason why we kind of brought this product amongst our product suite was primarily with to align with our thematic priority of private capital mobilization, because we firmly believe there's a large pool of liquidity which is available and can be leveraged to mobilize capital to those areas where particularly for infrastructure development, where they would otherwise not go without any support from a multilateral or a guarantee or a credit enhancement. So with that mindset, we operationalized our guarantee program earlier this year, which is primarily a comprehensive guarantee covering, we can cover instruments, such as underlying bonds, loans, and even trade finance instruments. In terms of, I can also kind of segregate the guarantee in two aspects. One is the sovereign backed guarantees, where essentially AIIB also benefits from an explicit counter indemnity from our member countries. So if in case there's any default and our guarantees triggered, our member countries kind of explicitly confirm that they would indemnify AIIB, and which is why we kind of provide the same spread, the same concessional guarantee terms, which we apply on our sovereign backed financing also. And in terms of tenor, we treat a guarantee in a very similar way which we would have treated in a direct sovereign backed loan itself. The second bucket is the non-sovereign backed financing, where anything which is not backed by an explicit guarantee from the member country would be treated under a non-sovereign backed financing, which is again a comprehensive covers any default, whether it's because of the credit default or a transfer and convertibility or any other aspects associated with the sovereign. On the non-sovereign side, because it is not, we can cover state-owned entities also, but because it would not be kind of backed by a explicit guarantee from the sovereign backed financing, the way we look at this would be from a commercial lens itself, and the way we would price it would be very similar to how we would price a non-sovereign backed financing also. Essentially, given our mandate, the end use of our the facility which is benefiting from our guarantee has to be linked to infrastructure. So any underlying instrument which we are covering, whether it's a bond, it's a loan, or a trade finance instrument, has to be kind of tied up to infrastructure. And talking about clean hydrogen, it is something which AIB is clearly looking at and actively pursuing this, given it fits both our thematic priority, which is the green infrastructure, as well as our updated energy sector strategy.
Thank you for articulating the products that AIIB is introducing in the market. So an opening question to sort of both of you is, whilst we all appreciate the need for the guarantee structures and instruments, there is an underlying slight criticism that the very problem the guarantee instruments are trying to solve, but some bureaucratic hurdles or the application of the instruments is not as easy, because the terms and conditions are quite onerous. So perhaps if both of you could reflect on that, are we seeing the implementation of instruments kind of becoming easier and more fluid, or it's still mired in complicated structuring processes?
Thanks for that question, Samit. Now, you have to understand both MIGA and if I could say AIB as well, and we're multilaterals. And so your statement depends on who you're comparing us to. If you're comparing us to a commercial loan that has incentives on profit maximization, then I think we are slower and we have more steps to take. But if you take us as a multilateral, especially the MIGA, I mean, I would say that we're actually simpler for a couple of reasons. One is the fact that we are working as a third-party insurer, meaning we don't need any government consent, government agreement. The only legally binding agreement we have in the transaction is a contract of guarantee, which we sign with the investor. Okay, so that simplifies the process for us.
And Jacob, you articulate your answer with perhaps an illustration of an example, no name basis, any deal that you may have done recently or in the past.
Sure. So basically, let's say this transaction we are hopefully closing within the next few weeks. We're supporting a project in India in the railway sector. We are negotiating the contract of guarantee with a commercial lender that will lend to a railway sector PSU in India. The government is aware of this project. They're supporting this project, and they've signed what we call a host country approval. But it's actually a notice that we send to the government as a shareholder of MIGA, where we kind of lay out the guarantee, the amounts, the investor, etc. And if the government opposes either this project or MIGA's involvement, then they have the right to do so as a shareholder. I have not seen yet any host country approval being denied. So it is a notice that we send to the government. So it's not a legally binding agreement on reimbursing MIGA if something happens. It's not like that. The contract of guarantee is the only legally binding agreement, again, that we sign with the investor. So let's say if the case in point of an Indian PSU, if they default, then we compensate the lender on that. Okay, there's no separate agreement between the PSU and MIGA. So that's the legal aspect. Now, on the due diligence, we follow more or less the same process as the World Bank or the IFC does, our sister institutions. So we check on the feasibility, the economic analysis, the bankability side, as well as the country risks that we provide cover for. And that requires, a few months of due diligence, including meetings with government officials. But it's not anything different from any other transaction that a multilateral or a development financial institution would undergo. Let me stop.
And for clarification's sake, for all the participants, the guarantee instrument could be offered to any commercial lender. However, the underlying counterparty risk should be a PSU or a sovereign or a sub-sovereign, correct?
So yes and no. For the credit enhancement, because we are covering public sector risk of the borrower has to be a public sector undertaking or a state government. Okay. Now, for let's say the breach of contract, we do provide covers to private. The political risk insurance, we do provide covers for private projects, but for the breach of contract cover within the political risk insurance, that is specific to agreements, let's say offtake agreements with the public sector.
So the cover is for the lender, provided the offtake is with public sector, and the provider of the energy or hydrogen in this case, that could be a private sector?
No, so the investor, so our client basically, they can be lenders or equity as well.
No, so let me rephrase this. So let's take railways as an example. A top tier bank is lending to railways and is asking for the breach of contract cover from yourself, but railways is buying green hydrogen in this scenario, and the providers of green hydrogen could be private sector, or
no. So in the rail example, that's a credit enhancement. So
okay.
So the structure will be different. So the credit enhancement is basically a corporate loan. It's not project finance. It's basically a corporate loan by the international lender to the PSU with a MIGA backing. Okay.
Yeah.
The example of let's say a green hydrogen project, let's say, and the offtake is by private sector, that we cannot support.
Sure.
Yeah.
Sure. No, got it. I think that's exactly what I was trying to bring out, and I think there's already a question from one of the participants on that. So thank you, Jay, for that example or two. Bhavit, follow-on comments?
Sure. Thanks, Anmit, for the question. And I fully agree with what Jay mentioned. It depends on, who do you compare, MDBs with in terms of, whether it's a commercial, a sector or the MDB. But within MDB also, and I would, say that, MIGA is one of the institutions which has been, quite an active, very active in terms of, issuance of guarantee as compared to other multilaterals who can offer both funded facilities and unfunded facilities. So, I kind of partially agree with your statement that for those institutions, those MDBs, which can offer both funded as well as unfunded structures like guarantee, the extent of utilization of guarantee has not been to the tune to which the potential has been. And there are some of the challenges which we as an institutions have kind of experienced while we were in the process of developing this product, and have been speaking with one or two potential counterparties in India, where we kind of intend to partner with them to support infrastructure. So if I were to talk in the context of India, I can clearly remember some of the regulatory aspects which kind of makes it difficult for us and for the market participant to kind of roll it out as quickly as we would want. For example, I think just to give you some example, there's a one regulation which says the risk weighted asset application on MDB exposure, even if MDBs are triple A rated, would be 20%, which is something which is kind of putting some kind of restriction or the attractiveness of the guarantee. So if a lender, in spite of getting a guarantee from a triple A rated entity, would have to have a provision of 20% RW. I'm talking about local currency financing, wherein RBI regulation comes into picture. Similarly,
So just clarifying. So you mean the lender would have to have 20% ring fence tier one capital?
yes, so 20% RW would be applied, as opposed to, let's say, if they were to kind of investing in IGPs, that would be 0% risk weight. Whereas you see that there's a clear difference in terms of the credit rating of sovereign versus MDBs. So a lender who's benefiting from AAA rated guarantee, lender of a local currency financing, would still be required to set aside some capital, even if it is kind of backed by a multilateral. Secondly, in cases where the guarantees are non-accelerable and there's a default and the guarantors kind of agree to pay at a scheduled commercial repayment dates, in that case also there's a provision which require lenders to have provisioning against the NPA, even if those are kind of guaranteed by multilaterals. I think there's again a cap on the local currency financing. So basically it says the guarantee fee cannot be extended beyond 2%. So that in many cases might not be sufficient to cover the underlying risk in those cases. Then there are certain additional characteristics or considerations wherein we kind of have to rely on the recovery aspects, and most of the borrowers in India would want local currency financing. Now, MDBs usually have a dollar denominated balance sheet, so there's always an element of FX risks, though minimal in emerging markets, because you are unlikely to see a local currency appreciating against dollar in the long run. But then there's still a risk associated with those. So how do we treat or tackle or take into account the FX aspects with respect to providing a guarantee on a local currency INR instrument? So these are some of the considerations, which are more to do with the regulatory aspects, which we have been kind of experienced of late, which would require a lot of engagements and discussions with the regulatory bodies aspect, also to understand their thought process and to come up with ways how we can come to a landing to. But then certainly there have been examples of late. For example, I think World Bank have recently partnered with SBI or SIDBI to support e-mobility in India. I think Guarantco, which is the UK government arm, PIDG's arm, have also recently tied up with one of the large commercial banks to support e-mobility ecosystem. So I'm sure there are ways to kind of address some of these challenges, but then this would require a lot of engagements with these institutions.
Dwelling a little bit more further on the regulatory aspect. So I mean, if it's a challenge for you, it's a challenge for all the instrument providers. Are you saying India's absorption capacity on guarantee structures and instruments is an impediment?
No, I would say it's a big amendment. I'm sure the regulations have been there for a reason. It is just that understanding their context and then how to kind of find ways to address the challenges which we see, and also to address the demand which the onshore lenders would want to have. Now, India is a very unique kind of member country from our perspective, because the local currency dynamics is also comes into play. If you have very less differential in the interest rate pricing between a dollar financing and a local currency financing, plus you add on to the FX element or the hedge cost to the dollar financing, then clearly a local currency financing would make sense for any borrower in the country. Uh, Whereas institutions like us have very limited capacity to raise local currency, which is why we usually rely on very limited instruments like swap market to fund our local currency assets. Now, which is why guarantee is a way through which we can mobilize uh, local currency financing in a cost efficient manner by partnering with financial institutions like large commercial banks who have got access to low cost current account deposits, savings account deposits, to mobilize capital to the projects and borrowers without AIB having to kind of raise local currency liability ourselves. So again, the potential is huge. It's just a matter of how we kind of understand, because we are also relatively new in this product, and how we understand the regulation, and come up with some of the early challenges which we are witnessing at this stage.
Just drawing a line under this particular aspect, Bhavit and Jay both, if because the purpose of these workshops is of course to educate the ecosystem and raise the general awareness, but also highlight certain policy barriers or gaps or key enablers that are needed. We need to highlight those to the government. What sort of in the previous workshops, all the lenders suggested bringing energy transition in priority lending sector, because banks are getting concentration risk, and they're getting uncomfortable in funding a very standard solar project because they don't want to increase their exposure. So yes, Bhavit, to your point, regulations are there for a purpose, but regulations have to evolve with the need of the day and the need of the next 7 years in this particular scenario. So what messages would you sort of give back in terms of maybe relaxing some of these regulatory burdens on provisioning or cap on pricing of the guarantee structures, because the very purpose for which we're bringing the guarantee, if that is not solved, then what's the point? So what message would you want to give out to the policymakers, both of you, Bhavit and Jay?
Yes, and so I think if I were to kind of come up with some of the recommendations, I think the key one from our perspective would be on the RW assignment against the claims on MDBs. I think across the world, I think Basel also gives individual regulatory regime to come up with their own RW assignment. But what we've seen is that many of the jurisdiction regulators have given the flexibility to assign 0% risk weight on claims on AAA rated MDBs. So I think that is something which will really help this product from the commercial lenders perspective, who would be the beneficiary of the guarantee, and make it more attractive for them. Again, if it's feasible, more clarity on regulations with respect to underlying securities, how restructuring of workout processes are being kind of handled, managed, will help new institutions like us to understand the underlying risk in detail. Any regulation with respect to the FX aspect would also help us. And if there's any kind of optionality to bring more flexibility on the pricing, as of now there's a cap of guarantee price fees which can be charged. If in case this more flexibility which can be brought in, just to keep it aligned with the underlying risk, so that the price, you have the flexibility to charge basis the underlying risk, that may make it more attractive for MDBs like us to kind of make it more palatable for our internal stakeholders also.
I think we're slightly different in the sense that, I mean, none of the MDBs are regulated per se by any country. But the only kind of, what's the word, limitation that we face in terms of local regulations in India is the ECB guideline. Because essentially we are providing cover for ECBs. So it's the ECB-related regulations that affect the MEGA covered loan. To your question on maybe some advice or suggestion to the government, I think just in India, the sheer size of financing going beyond the green hydrogen, the entire infrastructure ecosystem in India and the growth, the economic growth that the country is experiencing right now. I think it would be really good for the government to realize that the different financing sources have different objectives and different pricing, and they really should think hard about what financing tools to use to which kind of sector, etc. Because, for example, you have a lot of local liquidity, so that's a very large pool. You have export credit agencies that link to procurement, and that's very price attractively. And then you have the JICA and KFWs as well, who have some bilateral aspects. You have the multilaterals that come also with policy advice and other kind of softer, attributes, and not just the financing. And then you have institutions like MEGA, where our focus is to mobilize foreign ECBs to come into the country. So that's another pool, but at very longer tenors, so up to 20 years. And for a nascent industry like green hydrogen, I think it would make sense for the government to really think hard about, which financing source would be useful when investors are skeptical on, it's not as established as, let's say, a power generation. Okay, so there's huge technology risk. There's, even the government kind of offtake. Is this going to be government offtake? Is it going to be private sector? There's certain uncertainties, and so I think it will be useful for the government to think about the financing source as according to the current status of the industry, the potential government subsidies, government policies in place going forward, and the kind of scale that's needed to bring this industry to the kind of the mainstream financing market.
Very important point you bring up, that we need to be very, very specific on what type of capital source we need to go after for which particular part of the value chain or the ecosystem. India is serious about its decarbonization goals and objectives, and let's start with gray hydrogen currently being used. So India consumes between 5 and 6 million tons of gray hydrogen a year. almost half of it goes to refinery sector, and another half goes to the ammonia sector. So by and large, the buyers of the commodity are either very large public sector enterprises or very large industrial groups. The challenge, as we highlighted in the last workshop, is the need for a market maker. So the government's already highlighted and identified SECI as an agency which is already playing a key role in being the market maker and an off-taker for the renewable energy sector, but now it's been identified that it will be the nodal agency under MNRE for green hydrogen as well. So I think we can say that with a relatively high degree of confidence that the market maker will be a sub-sovereign or a quasi-sovereign entity. So your products and instruments would apply very well. Now, the challenge, the devil, as they say, is in the detail. What this market maker will do is give a 10-year plus offtake to a, let's say, a private sector company wanting to produce and sell green hydrogen, and on the buy side, the contracts are about anywhere between 2 and 4 years, right? So the mismatch has to be funded. And again, I won't go into the details of what we covered in the previous workshops on how do we reduce the price differential on the mismatch, but we can't reduce the tenor differential yet on the mismatch. So the tenor differential could be funded by a combination of carbon financing, by government grants and subsidies, but those two alone would not be enough. We need some form of government subsidy as well, which, if the government does not want to do it out of the current capital reserves, could issue a long-term bond. And again, a question to Bhavit and you yourself. In that scenario, what guaranteed products could be made available? Firstly, from MEGA's perspective, Jay, your product on counterparty risk and contract default, that could, I think, easily apply. So perhaps you can confirm. And Bhavit, you mentioned on the fact that you could not underwrite, but be a backstop on bond defaults as well. So how would your products apply to this particular scenario of a market maker?
The way a breach of contract works is, irrespective of the sector, if there is a contractual arrangement with the government or government entity, and SECI obviously would apply, and for some reason the government agency does not follow through on the obligations, which causes a loss for the investor, and that leads to termination, let's say, then MEGA would provide compensation to the investor. Now, we do require an arbitral award to be given to the investor as per the dispute resolution process in the offtake agreement. And it's mainly because we as MEGA, we don't know who was in the wrong, because it could have been the investor that didn't deliver the services that they were supposed to deliver. So we just need the conflict, the dispute resolution process to be exhausted for us to be able to provide the compensation to the private sector investor. Does that answer your question?
Yes, that's fine. So you've gone ahead and answered the question, but also clarified how the dispute resolution would take place. So let's say State Bank of India is a lender to various projects, but the counterparties, so Jay, just further detailing on implementation of the instrument. So let's say counterparty X is a private sector selling to SECI. SECI is the off-taker. The lender, let's say State Bank of India, is to the private party X. So the benefit of the insurance is the lender, which the benefit eventually flows to the private sector, but the borrower is the one who's getting the insurance, correct? Or
No.
SECI is? SECI is.
I hear your point. No, so basically, assuming there's a project company that's established,
Yeah.
okay, and it's the project company that gets the lending,
yes,
from SBI, let's say.
Yeah, yeah.
And so our client is not the project company.
Correct.
It's either the equity that's injecting its money into the the project company, or the lenders that are lending to the project company.
Got it.
And it's, if the compensation is provided to the project company, then that will be shared among equity and the lenders. Right. So those are the counterparts.
So the benefits flow down to the SPV, but it's the equity investors and the lenders who are eventually backstopped by the guarantee.
That is correct.
Correct. Great. So thank you. You've answered the question. Bhavit, on the bond construct, how would a wrapper, for instance, be applied to improve the rating of the bond?
Now, yeah, coming back to the potential application of guarantees in the green hydrogen space, which I believe is not materially different from other sectors such as renewable energy. And I think one of the lawyers speaker in one of the previous session also alluding to the same point. So I'll be making some references to the recently published report on the clean hydrogen by AIB. Thanks to my colleagues on the call from strategy and policy team who had come up with this project. If you haven't had a chance to look at the report, since the commercial risk in the green hydrogen value chain vary according to the engagement point, the report essentially tries to match various financial instruments to the commercial risk of each engagement point. Now, given the inherent nature of the guarantee product and the participation of the private sectors also, which can be domestic banks, financial institutions who would ultimately be providing funding to the borrowers, and which are also regulated, profit driven, and would also be required to have some skin in the game and clean risk appetite. The guarantees, in our view, are likely to be more effective in those engagement points within the green hydrogen value chain where the commercial risks are lower, because if the technology is established or the risks are related to other more conventional market factors. For example, let's consider those engagement points where either the relevant technology is mature or hydrogen technology is more competitive, or where there are certainty about the cash flows and commercial risk can be managed within the project's contractual arrangements, like cash flows and take or pay contract to supply hydrogen. In such cases, we believe project finance or even guarantees are likely to be more suitable for overcoming such risk. Let's say on considering the production side, providing project finance or partially guaranteed loans to domestic banks to support large-scale clean hydrogen production plants by, let's say, existing renewable energy firms that have secured offtake agreements for clean hydrogen. Maybe on the end use side, MDBs like AIB can assist efforts to roll out pilot projects by government in end use applications which have relatively high maturity, such as heavy land vehicles or industrial feedback, thereby creating conditions for market formation and commercializations. Now, in such cases, both a sovereign loan to support governments funded pilot projects, let's say in the example which we are referring to, if kind of Indian government comes and support an offtake through one of its SOEs, then either a sovereign backed loan or sovereign backed guaranteed, which will be given to the domestic lenders who would be giving to the SPV to enable growth of the private sector companies, can be a practical first steps to take. And the underlying financing can be in the form of a loan or can be in the form of a bond. I think a loan is something which is expected to be a more palatable one, because capital markets again has its own nuances. But once a sovereign is backing a project and provides a counter indemnity to institutions like us, we do have the flexibility to structure our guarantee like a first clause guarantee or a rolling guarantee or even a back-ended guarantees to make it bankable for the lenders. Similarly, other examples can be on the end use side around conversion of truck and bus fleets. Guaranteed loan may also be potentially looked at at investment companies which are likely to have wider corporate balance sheet to support repayment of the lending. So these are some of the thoughts which I could kind of share, to your question. So.
Very, very useful. There's a question, a relevant question from someone in the chat box saying, I think it's more addressed to Jay. In the case when you are backstopping the lender and equity, who gets the priority? So essentially, it's a waterfall question, right? Who comes first in the waterfall?
So there's no waterfall in terms of our compensation. Let's say, again, in the scenario where we provide cover for both equity and lenders, then once let's say the termination payment is awarded to the investor, to the project company, sorry, and the government or government entity does not pay the termination payment, then MEGA has to pay, right? So we will pay both equity and lender at the same time, as per the arbitral award. So, and it really depends on how the contract is drafted. So assuming that there's a pari passu compensation to the project company, sorry, there's no kind of limitation on how the project company can provide its funds, and it just goes to the project company, then there's no kind of a waterfall for MEGA.
Right. Okay. So both are paid equally, and depending on what's mentioned in the contract. So just a follow-on question, Jay, do you publish, or are there model contracts available, or model terms of references, if not contracts?
We did have our contract template in our website until a couple of years ago. Now it's come down, but I'd be happy to share the contract template to whoever is interested. Feel free to contact me.
That would be very useful, Jay. Yeah, thanks. As most of you know, we are writing a library of structures and instruments. More than 35 to 40 structures and instruments have been identified already. And with every call, we bring out one more or two more new structures and instruments. So, Jay, this would be a great aid memoir to that library that we are producing and will be publishing next month. So a very important question. One of the participants asked is, most of the guarantees are kind of focused on sub-sovereign PSU entities. What, if any, structures are available directly for private sectors? Because they will be the most significant players in the capital formation. Whilst I understand they are the indirect beneficiaries, right, in most cases, but are there any products or structures available, instruments available directly for the private sector? Jay, you've already answered in the sense of the counterparty risk security structure that you're offering. Any others, both Jay and Babit?
I'll respond very quickly. For us, it goes to our establishment, and we were established to take away the public sector risk for the private sector, with understanding that the private sector would understand the private sector risks. So that's why for us, if it's private sector offtake, I'm afraid there's not so much that we can do. Thank you.
Sure.
From our perspective, given our mandate is to support infrastructure, we are agnostic. Whether it's through public sector entities or private sector entities, as long as the money is ultimately utilized for supporting green hydrogen projects, we would be happy to support both public sector entities as well as private sector entities. However, through both our product offerings, whether it's a sovereign backed financing where there's a pilot project supported by government, or it's a non-sovereign backed guarantees where there's very limited involvement of government. Having said that, given the stage where the sector is right now, which is pretty relatively new, there are numerous challenges and risk associated with the sector. I would believe that I think public sector is the one which should be kind of coming forward and might have greater chances in terms of addressing those risks which is being seen by lenders as well as multilaterals, because it's a new sector which requires a lot of education at everyone's end, so I think while we can offer it for both private as well as public sector entities, but essentially I guess that is the public sector which is going to be the front runner on this.
And I agree, Bhavit, that public sector will play the most important role in enabling and creation of the market. And once the market reaches a steady state, more and more commercial products will become available. But glad to know that you are able to offer your products to both public and private. And I think the likes of Garanco and others can also do the same, if I'm not mistaken. Yeah. So thanks. I think people want to know a little bit more about who can be the beneficiary. So another question: if it's a 50-50 JV between a government and a private entity, would the covers still apply?
So I need clarification whether the JV is at the project company level, in which case it doesn't matter for us, right? But if the JV is the off-taker, so basically it's a majority held government majority held SOE, then it is eligible for a cover.
So 51-49, right? So 50-51, got it. Yeah. Okay, great. Thanks for that. Just sort of leading on to the next logical question is in terms of pricing, right? Whilst there is, as Bhavit mentioned, there is a certain cap, as is in the ECB segment, cap on pricing on premiums that could be charged. Could both of you give a sense on using a couple of examples on what is the pricing for these guarantee structures and what is the impact on either the availability of funding because of the guarantee instrument, as well as the cost of funding that becomes available because of the guarantee instrument? What's the impact of the guarantee instrument on capital provision as well as pricing as a result? So any examples that you can share would be very useful. Jay first, and then Bhavit.
So our credit enhancement was designed to be Basel compliant. So the lenders that get this cover get 0% risk weighting on their assets. So that's why they're able to provide a loan at longer tenors, let's say up to 15 years, at relatively reasonable prices. Okay. Now, in terms of pricing, obviously this is confidential information, but it can range anywhere between 0.8 to 1.5%. Depending on the credit worthiness of the SOE itself, and the tenor, the amounts, etc. Now, that's a credit enhancement. The breach of contract is not Basel compliant. It is a risk cover for both equity and debt. So some lenders give some upside into their internal risk kind of a grade. Some lenders don't. It really depends on the risk perception of the project and of the meager breach of contract cover of each individual investor.
And do you require the projects to be rated prior, Jay?
So
by a third-party agency?
That makes our job much easier, but we do have an internal team that provides this service to us based on the kind of financials and historical kind of data that is provided to us.
And you would use the same metrics as one of the three major rating agencies, or you have your own internal sliding scale metric system?
Yes. So we have our internal kind of team that conducts it in their own internal method.
From our perspective, as I mentioned initially, we have two product offering. One is the sovereign backed guarantees, and the other is the non-sovereign backed guarantees. On the sovereign backed guarantees, our pricing is concession in nature, and it's in public domain. So I think if I recall correctly, it is 50 basis point for tenor up to 7 years, and then there's a maturity premium of I think 10 or 15 basis point for the brackets above that. The same guarantee fee apply for any member country, irrespective of the member country's credit rating. However, that sovereign backed guarantee can be applied or can be issued only in few currencies, dollar, and then I think there are few more. Some of both the transactions which we have done so far are sovereign in nature. On the non-sovereign side, again, it is slightly confidential, and it's more of a market-based, risk-based pricing which we apply depending on the underlying credit rating of the obligor, the tenor, and various other factors, so as to kind of meet our internal returns threshold. So it's much more kind of complex and more of an internal discussion rather than the sovereign, which is very transparent and there on our public domain.
Broad range on the non-sovereign side?
It's a difficult question to answer because again
you leave money on the table. Okay, fair enough, Bhavit. Just to both of you, what sort of impact, if you can illustrate with an example, whether breach of contract, capital was not available, MEGA guarantee comes in, the capital becomes available at this pricing. Have you seen a significant shift in the pricing of the capital available because of the guarantee? I'm just trying to eke out some sort of correlation between the impact the guarantee has on the pricing.
Okay, so for transactions, especially in South Asia, we work closely with our sister institutions, IFC and the World Bank, who are more upstream, and they provide advisory services to the government, who may be bidding out some of these projects. And in those cases, we incorporate our term sheet into the RFP package. And that term sheet, has some broad range of our pricing. Now, this allows a wider range of investors to be interested in the project because they see that MEGA has, in principle, interest in supporting this project. So I think more than the pricing itself,
it's the availability, the unlocking of capital that becomes available.
Exactly. And on the credit enhancement, because that's the comprehensive coverage. So for the lenders, it's very simple. You get the MEGA AAA rated cover for 95% of the exposure, and they calculate the 5% naked risk, and they run the price. It helps if the government entity runs an RFP process again. that will definitely add to the competition and reduce the price. But I mean, it's very different, the price that these lenders are able to lend without the MIGA cover and with the cover. Both in terms of tenor and the price, it's quite significant.
Right. Bhavin?
Yes, and I'll echo what Jay mentioned. It is not just about pricing also, but also about access to capital. So the one example which I can quote from AIB side, I think we've done only 2 transactions till now. You might have seen in the news we helped Egypt government to access panda bond market in China to raise capital for deployment in renewable energy sector. So without our guarantee and peer institutions co-guarantees, it was very difficult for the country to kind of access that market, but our guarantee kind of helped them access the market and also achieve some some significant savings in terms of the pricing. So that itself is one of the examples which I wanted to share from related to your question.
Great. And I believe with India getting included in the JP Morgan's EM bond index, the demand for the wrapper product around Indian issuers, Indian bonds or Indian paper will just skyrocket next year. Hopefully that should open up the market in a much broader way.
Yeah, I mean, I was looking at rating agencies' comments. While they acknowledge that it's a positive step, but because the cap on the foreign holdings is limited, I mean, the market participants are not very sure in terms of what is the benefit it will bring in terms of the yield compression of IGBs. But certainly, it's clearly a positive step. I have happen to be working in my previous organization with Indian government, so it's something which is very close to my heart also. But it was long awaited. Finally, Indian government was able to kind of cross the hurdles with respect to tax and other issues, and then got included.
Yeah, I mean, yield compression apart, just the access to institutional money, that's a huge step. Of course, the FX risk is another underlying risk, not for this particular dialogue, but something we'll cover in subsequent workshops.
Well, certainly, I think from MDB's side, there's a clear angle for IFIs to play in support of this sector. I think most of the organizations are clearly, watching it actively, and identifying opportunities to support the sector through a range of instruments, not just guarantees, but I think through debt equities are also depending on what are the risk factors with respect to each engagement point across the value chain of hydrogen. I think it's an interesting space to watch out for, and I think we as an institution, AIB, clearly fits our sector strategy, and we are having an open eyes towards supporting this sector.
As the PSUs are availing the guarantee instruments, are they doing so because they're not among the highly rated ones, or they are just doing so they can get access to financing or more financing, if that is the case?
Yeah. So again, and I'm very cognizant of the good rates that the PSUs are getting, especially from local lenders. I think one aspect to that is that the SOFR is so high right now. The interest rates on US dollars are very high. So I think back to just that's a couple of years ago when the SOFR was, let's say LIBOR at the time was 0.5, let's say. I mean that's when many PSUs were availing of ECBs. Okay. That's one aspect. The second is the tenor. I mean the PSUs don't require long tenors, then they don't need us. It's the PSUs that have long dated assets, 10, 15 years. They're the ones who require a stable financing source for 15, even 20 years. that could benefit from a MEGA covered loan.
So hopefully that answers.
So one of the ways to look at it is that when we had the sort of renewable energy transition, assets were all mainly project, right? I mean, at an SPV level. Of course, you also have the unique case of PSUs themselves, sort of, developing RE assets, but that's a whole different ballgame. But at a private level, they have been SPV financed or project financed. And I'm asking from the perspective of green hydrogen. Do we really see project financing emerging for green hydrogen in the early stages? Or is it likely to be some form of corporate financing or asset financing? So just a question on that.
Let me have a go at it first, and happy to take comments from Jay or others in the room as well. Gagan, we covered this ad infinitum in the previous 4 workshops, and the answer is the project finance is not happening, right? And as a result, the developers are taking the entire exposure on their balance sheets, so funding it through equity, which means there's a limit on the size of the project that they can fund. If the size of the project comes down to tens of megawatts, it's just not interesting for any of the large off-takers, right? So there is a size mismatch. The financial closures are not happening, and projects are not reaching FIDs. So how do you come out of this deadlock? That's the role of the market maker, right? So the market maker is saying, I'm a AAA rated institution. I'm going to give you a 10-year offtake, right? Whilst the market is still at 3 years or 4 years or 5 years, whatever that may be. And that's not just a tenor. There's a price mismatch as well, right? And there's a volume mismatch as well, right? So the market maker's role is threefold. Not just aggregation, as most people think, it's just collecting, mopping up what's being produced and who's buying. It's the risks on pricing, or mismatch on pricing, mismatch on tenors, and mismatch on volumes, right? So these are the 3 principal risks the market maker is taking, and then we kind of broke it down into how do you minimize the pricing risk. Blended finance and the cost of renewable were identified as 2 inputs that would have highest sensitivities to the IRRs of the project or the bankability, and a AAA rated institution. So, and with that AAA rated institution, the MEGA product can apply. So I think with the MEGA product coming in, and we'll use SECI as an example, for the benefit of SECI, kind of jumpstarts that market, and hopefully we should start seeing financial closure. So hopefully, Gagan, that answers. There's a question on what are speakers' thoughts on first offtake guarantee scheme to support early offtake for GH2 in the case the green premium does not attract traction from the consumers. Arjun, are you saying? Okay, I think what you're saying, first offtake guarantee. Arjun, in the last workshop, it was identified that storage could play a significant role in market making, right? If government could invest in storage, which both doubles up as energy security, but also plays a role of that first offtakes, physical offtakes, not just on paper, that could jumpstart the market making institutions' activities, and would definitely shave off, if not the entire green premium, but a significant portion of that.
Partially, yes, Anmit. I can perhaps have a follow-up as well. What I was also referring to, in terms of the first offtake would be if let's say a multilateral or a sovereign fund of sorts would be able to support at least the first revenues. Let's say the first 6 months, first year's revenues from a project, That way, you're ensuring at least the initial offtake, initial revenue streams, to the particular project. So you have your early stage revenues so taken care of, and that obviously on a levelized basis, in that improves your LCOH or LCOAs as such, right? And this would be blend of concessional financing, sovereign backed financing as such, might be at a cheaper cost of capital, which then would improve how you would finance the longer term tenures as such, right? So the intent of here, with such a scheme would be to look at least supporting from concessional financed cost of capital the project, at least in the early years. So your initial revenue stream is taken care of.
And this is pre-construction or post-construction?
Good question.
Post.
I mean, it could be even post-construction, Sumit. It could be when the debt repayment as such starts off after moratorium. It could be extending to there as well.
So Jay, is there a early dip instrument or a structure available in the market, according if you have any visibility on that? So before the deliveries happen, the banks will come prowling, right? So
yeah. So
this was before you answer, Jay. This was identified by 2 developers in the previous workshops as an instrument or a structure that would go a very long way in impacting the market in a positive way.
I think our sister institutions will be better placed to answer the question, because they're the ones who are designing the upstream and the structures of transactions to make them bankable. We come in to provide assurance or guarantees to make sure that whatever the bankable structure is, that the government follows through on that. I mean, just to answer your question, I haven't seen any commercial lenders come to us and inquiring on this structure, and which is understandable, because the structure has not been kind of agreed to in a commercial sense yet.
Yeah, Arjun, I don't think a product exists. The opposite of the product exists, where the lenders are asking 18-month DSRA, right? So, which is not good for the developers, but essentially in response to the 18 months DSRA, because in some cases the revenues could be delayed, or the counterparty risk is such that it's not a AAA rated counterparty. So lenders are wanting more liquidity set aside, but a product was highly recommended that would help in increasing the bankability of projects. So that's already been taken up. So thanks for bringing it up again.
Sure,
I'll take a couple of more questions, and then we'll kind of bring it to a wrap. There's a question on building on point just raised, creative question on agreements. Could 2 companies pitch a 20-year agreement with a parallel track of long duration LDES, long duration energy storage, short term, and green hydrogen long term, both start to build at the same time and work on permits and de-risk the portfolio, so the customer gets benefits at different phases and builds in durability and range of benefits? What do you think is a regulatory angle?
So I think she then came with another question that replaced the previous one.
Okay. I did. Thanks, Jay. Because Arjun asked a similar question what I did, so it was pretty much answered. But I am curious, Jay, you've answered a couple of times. You keep saying it's got to be AAA. Is that a mandatory criteria, or can it be a AA or lower?
No, sorry. What I was trying to say was that we are AAA rated, and so that gives the comfort to the lenders, where because of a comprehensive guarantee, they can price us rather than, let's say, Indian SOE risk. So that was my point. Now, to your question on whether the counterparties that we are providing cover against, so the Indian SOE offtake risk, let's say, that can be less than AAA, absolutely. And I'm talking about local India rating AAA. If it's BB, that's fine with us.
Okay, great. Thank you.
And that would just reflect in the pricing, Jay, right?
Right.
That would be reflected in the pricing. Yes.
Of course.
Julie, answers both of your questions?
Yes, thank you so much. Great conversation.
Can Mega provide a guarantee for an AP discount? Wow. Okay.
I'll have to answer in a more generic way, which is it'll depend on the due diligence on the creditworthiness of the AP discount.
I guess our reactions gave the answer. Yeah. No, but I think there are products out there, and it's our collective responsibility and role to sort of increase the bankability and investment absorption capacity of the institutions, and that's really why these workshops and this program has been designed, so that more and more downstreaming of disruptive innovations, financial innovations, can happen. Thank you to Jay from the World Bank, as well as Bhavit from AIIB, who both of you were very informative, and thank you for the candid interactive nature of the particular dialogue we had, Jay. Hopefully we'll carry this collaboration further on, and we'll take matters offline with you and discuss some very specific ideas and structures that have been identified already, and some opportunities. The next workshop is on carbon financing, which happens exactly a week from now, next Wednesday. I think we are back to the 3 p.m. India time slot, if I'm not mistaken. That would be workshop number 6. The 7th and 8th are focused on how do we bring large-scale wholesale equity and wholesale debt into the Indian market. So do join us for those workshops. And finally, the workshops culminate in our Climate Impact Summit, Finance Summit on 28th and 29th of November in New Delhi, which is being done jointly with MNRE and the G20 Secretariat and a whole host of partner organizations. So on that note, thank you so much for your time and making this workshop very, very informative and interactive.
So the next workshop is next Wednesday. It's on the role of carbon markets and green credits. We have Proclim, who will be leading that workshop with a presentation, and we possibly would have DSK Legal. That's confirmed. And also, I think, Gagan, you and your organization was also interested. So we'll be happy to have you guys on board as well. And starting next week, we are going to open up this workshop to a larger audience. We've been getting a lot of positive feedback from several stakeholders, and a lot of them looking at the recordings as well. So we'll be happy to bring everyone in. So if there are experts or interested people in your organization, please feel free to, send across the registration link or just leave me an email. And like Samit said, the 28th and 29th is when we are having the Climate and Energy Transition Finance Summit, which is proving to be one of a kind, because there's no summit or event that is exclusively focused on financing in green hydrogen. So this is why the MNRE, even the PMO's office and the G20 Secretariat are supporting this initiative. And if you'd like to be part of this summit, you are part of the mailing list. You will get regular updates. But if you can't find the registration link on the website, just drop me an email. So finally, thanks to everyone who stuck along so long. And this was a very fruitful discussion. Thank you once again. And I look forward to seeing all of you all on the next workshop.